If everyone can just make sure that their microphones are turned off, that just helps with any background noise. And just to let you know, we are recording this presentation so that it will be available to distribute afterwards. So I'll pass you over to Graham now.
Thanks, Vic. Put the agenda up, Carl, please. So I think there's been so much speculation in terms of what was going to happen over the last 2 months. Reality was that at 12 o'clock yesterday, we'd seen the office of OBR had made the announcement and had inadvertently, depending on what your views are, released the full documentation before the Chancellor actually stood up. So my own personal view was that it just summed up exactly what's been going on for the last couple of months. And I don't know what people's expectations were. I don't know what the message that the government was trying to do, but today is just about the reality. We've had lots of discussions with people about what the necessary impact was likely to be. We averted a lot of that and just said that we can't give any guidance, we can't give any recommendation when we don't know what is actually going to be going on. But here we are, 24 hours later, so we'll try and cover off some of the impacts of what we know about. If anyone wanted to read what the revenue actually produced yesterday in their thicker document, again, it's short on a lot of details, and again, both Rachel and myself can only tell you what we've already been presented with. So there is likely to be a lot more technical details that are going to be issued over the coming weeks. The reality is a lot of this, as you'll have seen in the press, also on TV, a lot of it is further down the line. So the impact in the short term is relatively limited, to other than the stuff that we knew about last year that takes effect from in the next couple of years. So I'll press on very, very quickly with a whistle tour on the pension investment landscape. Rachel will cover the taxation base, and then we'll take any things at the end as a Q&A. There will be a document coming out, certainly from both of our sides, in the next 24 hours with some of the further details that you will get from this. So pensions, my baby. I'll be a multimillionaire with the conversations that I've had with people over the last few weeks in terms of this. Quelle surprise, no change. Tax-free cash, no change. Tax relief on pension contributions, no change. No change to the annual allowance. So all the things that have been highlighted in the by some of the popular press, that this is what's going to happen, hasn't happened. However, we thought that there might be some potential changes on the inherited pensions, but from April 27, and I know some of you that are on this call have got concerns over that, we haven't had any changes. Suffice to say that hasn't been brought forward, but it hasn't been changed. But IHT on your pension pots on death comes into play from April 27. Again, the state pension and the triple lock. It's very, very difficult for any government to try and get out of that. It's here for the duration of the Parliament. It's increasing. It's a circa increase of around about 5%. So all of your privileged people on this call who are over the state pension age, you can look forward to an increase of virtually 5%. And obviously that's, now that is going to take up your full personal allowance. So there is little or no scope if you've got any other income that you're going to be caught in the tax bracket. Rachel will talk more in depth, in terms of that. So next slide. This is the main one, and some of you who are working will be affected by this. It's a little bit of a busy slide. Suffice to say, those of you who are still working, and it's fairly common, most of our corporate clients pay their pension contributions through this method, which is called salary sacrifice. There's an argument that's been raised that it's been too generous. Some employers recycle any national insurance savings back into someone's pension contribution. It's going to be limited to 2,000. Again, as I said at the very, very beginning here, it's April 29. Anything could happen in that period of time. Suffice to say that those of you who are concerned about this on this call, that from an employer point of view, you've got plenty of time to decide which direction that you're going. Call me cynical, will it ever get implemented? Will we have a change of government? But again, there's nothing that should concern an employer in the short term when they've given this measure, which is going to be from April 29. So it's a little bit of a busy slide. Don't intend to go through that, but our corporate team will be in contact with all of our corporate clients in terms of explaining the implications. But don't worry, it's April 29. Investments. Again, there's a couple of little things there. It's tending to be more at the more for people who are looking at business property relief. We've been getting more and more inquiries in terms of that area. It was open-ended. There was a thought process that business property relief could be under a little bit more scrutiny. They've kept that at the £1 million, at the £1 million mark. There is this effective tax rate of 20% on AIM investments, and again, that's something that comes into effect from 26. VCTs, venture capital trusts, again, I haven't had any discussions with any of the providers on this. That was slipped in a little bit unannounced yesterday. Relief drops from 30 to 20. You're still going to get some relief. Doesn't make it as attractive as it doesn't make it as attractive as it currently is. Again, don't know what the thinking and the rationale is on that one, but we'll have to think that one through in the coming months. Anyone thinking of doing something before April, it's still at the 30% level. Investments. Now, this is something that again, we'd had advanced information in terms of we're thinking of doing various things, and there was so much talk in terms of where ISAs may be going. To be honest, personally, I was a little bit surprised that the allowance remains at 20,000 and they've given a time period of something like 2030. I thought that could have been maybe reduced, but okay, it hasn't. So we've still got the same situations with regards to that. You can still have multiple providers, so you don't have to put all your eggs in the one basket. Cash ISAs, though, is going to be reduced to 12,000 from the 6th of April 27 for those under 65. Again, can't understand the rationale that, again, you can put cash in if you're over 65. Does it mean that those people don't take investment risk? We don't know the detail of any of that in terms of if you did 12,000, you did 8,000, what it means in terms of where you invest the money. But again, being knocked into the long grass a little bit, so we've got over a year to think about that. Suffice to say that anyone who is currently making an ISA contribution, you're 20,000, and if you want to use cash, it still remains the same. My slight take on this is that when everyone was having the allowance in terms of what you can earn, which will be covered in Rachel's bit, so the interest rates that you could get on cash were relatively low. So you could see the rationale now that if you can earn 4% or something like that in cash, it takes you over and above your allowance. If you're then just switching that into an ISA, it's revenue that effectively the HMRC are actually losing. So there is a little bit of rationale for that. Why you keep it for an age group over 65s, I don't know. The last bit, lifetime ISAs, I can't get particularly excited about because there's very few people who are doing that. So Kelsoprees, it's been scrapped. And there is going to be a consultation in early 26 with regards to that. So in essence, in the short term, nothing for anyone to worry about with regards to ISAs, no upper limit in terms of what was maybe being said that you could only have up to a certain amount, 200,000, 500,000, lots of speculation in terms of that. So it's really not a lot of change. And as I say, it's only from April 27 anyway. So my bit's finished in terms of the pensions and investments. I'll pass over now to Rachel, who can go through some of the changes that affects taxation. Are you there, Rach?
Rachel, are you there? We can't hear you. Looks like Rachel's having some technical difficulties. She was on earlier and working fine.
She's showing us on the call.
Yeah. Okay, in the absence of,
Do you want me to plough on?
yeah,
I know the
I think
slides.
so.
Right.
She's maybe Teams has decided.
Unfortunately, you're going to have to listen to me for the next 5 to 10 minutes just on this bit. So, yeah, I'll press ahead. So the key points on the tax, which again, so much has been leaked with regards to this, no surprise there. The freeze on income tax thresholds has been extended for another 3 years, so it's beyond 28. Obviously, with inflation as it is, it's meaning that more people are falling into high rates of tax bands if and when they receive any increase in terms of their income. The tax burden is set to be a record 38% of GDP by 2030, and this has obviously been driven by the frozen thresholds and the new measures that have been introduced. So again, there you can see where the tax bands fit in, and where you start paying, higher rates.
Guys,
Oh, yeah, she's back.
Are you back?
sorry about that technical issue.
Okay, over to you. I'll shut up.
Oh dear. Thanks for that, Graham. And again, apologies for that. IT. Yeah, as Graham was saying, freezing on the allowances, and no increase in income tax rates for salaries. However, because of the freeze, in essence, going forward, whenever pay rises are on the cards, it's going to mean that more of that income will fall into higher rates or be taxable in the first place, which in essence is achieving the same result as a rate increase. So that's kind of a bit of a red herring. So the next the increase, they did actually increase the tax rate on property income from 5th of April 27 by 2%. So property income tax was 20%, or being 20% basic rate, 40% and 45%. So they're being increased across the board from April 2027. Also an increase, also the mansion tax they brought back in for properties worth 2 million or more. They face a high value council charge. That comes in from April 2028. Yeah, so that's where we are on that. How it looks on paper for the property tax rates. Are you able to go on to the next slide? So we've got a scenario here of 50k rental income. Under the current regime, under the current tax rates, the tax liability would be 7,486. Now, from April 2027, when those rates increase by 2%, the tax liability would be 8,230, so 745 quid increase. Now, it's not on the slides, but if we increase that income and say you were earning 100k, then that additional tax would be 1,739. If you go a step further to be an additional rate taxpayer, then the difference in tax would be for 2,241. So it isn't insignificant. So yes, so that's property tax. Also, if you don't mind going on to the next slide, Vicky. Also, I thought I must mention, while we're on property tax, also for landlords, the Making Tax Digital initiative that will come in from April 2026. People were hoping that she was going to announce the abolishment of that, but yeah, it's well underway, and those who with gross trade, either a gross trade, so it only applies for sole traders, self-employed people, not partnerships, self-employed and rental landlords with trade or rental income combined of more than £50,000 in the 24-25 year. Now, if you hit that threshold in the 24-25 year, you will. Can you just go back to the previous slide? Thank you. You will end up in Making Tax Digital from 6th of April 2026, and what that means is you need to basically employ MTD compatible software and maintain digital records and send those in on a quarterly basis to HMRC, along with the year-end tax return as normal. And as I said, that is mandated from 6th of April 2026. Those limits then will go down. So 50,000 from 6th of April 2026, that limit will go down to 30,000 in 2027, and then down to 20,000 in 2028. So catching more and more people in MTD, unfortunately. Thanks, Vicky. The most recent increase is actually on dividends, because that will take effect from April 2026. And again, it's 2%, only on a basic rate and the higher rate. The additional rate won't change. So 8.75% has gone up to 10.75% on dividends, and the 33.75% has gone up to 35.75%, and that takes effect from April 2026. The savings income, that will also rise by 2%, but that takes effect from April 2027. So the rates will be 22%, 42%, and 47% for additional rate taxpayers. Significance for company directors. Really, this is just the past. We've always, the benefits have been, the tax benefits have been a director of a limited company and receiving a small salary of the personal allowance, and dividends. It's still beneficial, but that margin is that when they up the rates, the dividend rates, that margin is decreasing each time they announce a budget, basically, and increase the rates. So it's just a point for consideration, really. It's still tax efficient, but it's definitely a planning point for going forward for director-owned companies. That leaves us really with the minimum wage rates increase for the employees aged 21 and over. It's going from £12.21 to £12.71 from April 2026. National minimum wage for employees aged 18 to 20 is going from £10 to £10.85 in April 26. And then the national minimum wage for age 16 to 70 for your apprentices and your 16 to 17-year-olds from £7.55 to £8. Again, which is good, obviously, for us for low rate paid people. However, don't know how it will affect. Well, obviously it'll affect employers, and maybe more skilled workers. It will affect their pay rises going forward, because employers, they're just getting hit from all directions. I mean, they were hit last year with the national insurance hike. They haven't changed that this year, but in essence, it all points to the same thing, that the rates are going up and up.
Thanks for
Thanks,
that,
Vicky.
Rach.
I think that's
That's you done.
okay.
Yeah. So. Right. So I just wanted to finish off on a couple of other things that were also announced, and again, one of the things which was announced affects me. How the heck they're going to work out a new mileage tax from April 27 on electric cars, I don't know. We've got no details with regards to that. So please don't even ask me a question how that can be applied from. The highlight was obviously the two child benefit cap, which is scrapped from April 26. The fuel duty is then frozen until September 26. They've said then that it's going to be reversed through a staggered approach. What that means, we don't know, and whether that it will be just then extended a little bit further. It's not included in any of the changes, but we did anticipate as an industry, so this is me speaking from a financial planning point of view, that there might have been some changes to inheritance tax and gifting, and there's been nothing mentioned about that. So I've welcomed that as good news because it's giving us clarity. So some of the discussions that we've had with people who are on this call about taking and gifting out of excess income that we thought might have been tightened. The 7-year rule might have been reduced in terms of what you can actually gift, and the time period extended. Nothing. So we can only assume that that represents good news. As I say, nothing mentioned yesterday, so all of those things are still on the cards from a planning point of view. From an investment point of view, we've got to get our thinking caps on, because there's certain investment products whereby if they are producing income, they're going to be caught out in the future in terms of the allowance that you're going to get with regards the dividend allowance. So again, we've got time to plan that around. And the one area that came up under a lot of talk was the capital gains tax allowance, and speculation that that might drop to zero and be included in terms of your overall level of income and taxed then accordingly. Nothing on that. You could argue and say it's so little that it's not worth bothering about, but you know, they didn't do anything with regards to that. So we've at least got a little bit of allowance there to play with if you've got investments in areas that can benefit from that. But it's becoming increasingly difficult, and if you've got gains, you either have to pay the tax or you sit on your hands and you don't exercise your right to that investment. So have we been given a little bit of a free hand in terms of, oh, it's not as bad as we first thought? Bearing in mind, everybody on this call is going to have an impact, whether you're in retirement or whether you are you're in work at whatever level of income, because of the freezing of the benefits. So you can dress this up whichever way you want. There's a tax charge coming your way on everybody. I'll leave it to everybody who's on this call to view whether they think it's not as bad as what was first thought, or it's like, well, you've just got to grin and bear it. There are still some opportunities that we can use, but it's getting more and more difficult. We've got through this in just about half an hour. We'll take any any questions that anyone wants to put forward, leave that to you, Vix, if there's any questions.
I've had a question on the chat, which is regarding lifetime ISAs, and if you have a lifetime ISA, will you still be able to add to it going forward, or is it now frozen? Now, I think we touched on that briefly, which is basically saying there's going to be a full consultation by the government on ISA reform in early 26. So I don't think we've got any more information on that at present. And I think it is just a case of wait and see what the first quarter of the new year brings on that. And we can address that then. But there's no real detail at the moment.
Yeah, I would certainly echo that. If there is one little bit of good news in terms of this, and also with the salary sacrifice, that any lobbying from an industry point of view has said, "Oh, don't do this on the hoof." It needs time to address it and plan it so that you don't just land it on the industry and providers in such a short time scale that no one knows how to do it and it hasn't been, drafted accordingly. So the ISA bit does look like it's more, I don't know, 2 years down the line before any of these changes will come about. If you're under 65, and we know about the ISA changes in terms of cash, and cash is your preferred choice, maximise, just maximise. It's clear that there's no upper limit in terms of how much money that you're going to have. But if you've got savings and it's sitting in an ordinary account and you are earning potentially on interest more than £1,000, you're losing potentially that tax-free growth. So stick it into a cash ISA, basically, before the limits do actually change. And I think if you've certainly got this year, and you've certainly got next year, and then I think there's a whole host of things that you might want to consider. But you've got time, and you don't have to do things particularly off the hoof.
Okay, I've no other questions at the moment. Just to let everybody know that we will have a budget update newsletter, hopefully going out later on this afternoon, and a short video as well. And the guys at Davies Tracy have also got their own update and what it means from a tax perspective as well, going out to their clients. So there will be some more information coming out, and we'll be sharing any further information once we get a bit more detail on different aspects of it. So we'll share that as and when we get more information. But apart from that, if there's no other questions, we'll leave it there and let you get on with your day. And thank you for joining us.
Thank you.
Thanks.